I'm James Robinson. This is my stock pick of the week, and this week we're talking about Medifast and we're talking about dividends. I haven't talked about this much, but I've set up a Twitter account. That's at Robinson Stocks. I set that account up because it takes a few days from the time I decide to buy a stock to the time that I can get a video made and posted on YouTube. So if you want real-time information on my trades, if you want updates on when new videos are posted, and or you want news and thoughts on the market or stocks in our portfolio, then go ahead and follow me on Twitter. Also, please subscribe, like, and comment. It all helps as I'm trying to grow the community. Finally, if you have comments or thoughts on any of these things, I am interested. I'm not just trying to have a monologue. I'd like to have a dialogue with people. So feel free to give me your comments. I'd love to hear what you have to say. Thanks. Medifast has only been paying dividends since 2016. But you can see here they've raised the dividends every year. They've raised them pretty significantly. I would expect that trend to continue actually for another couple of years unless they start to buy back stock. This company's putting a lot of money aside. They're making money. They don't seem to have a lot of places to spend it. They have no debt. So I think they're going to continue to give money back to the shareholders. So I'm really comfortable that this is going to be a trend that continues. As we do every time we look at a stock, we don't just look at the dividends and what's happening. We look at four factors. We look at the dividend yield relative to the stock price and its growth. We look at the dividend safety in the context of earnings, dividend safety in the context of cash flow, and we look at dividend safety in the context of the company's current debt load. So we'll go through those analysis pretty quickly. So here you can see yield and growth. The company, at the price I bought it a couple days ago, yields 4.03%. The S&P 500 yield average is 1.92%, so it's about 2 times the average yield for the S&P 500. The dividend growth, well, it's almost doubled in the last 3 years. It hasn't been paying a dividend for that long. So we don't give that a ton of credit, but you can see that it is going up each year. And that, for example, last year it went up about 45%. The year before that it went up about, just about 30%. So we're seeing very good growth and we're seeing a very good yield. Those are signs that this company is doing well and that we would like this as a dividend play. Dividend safety in the context of earnings. When we look at dividends, we obviously want to know what yield we're getting. That's the return we're getting on investment. We want to know if that's growing. We've talked about that already, but that's not really enough. We want to have a sense for if the company is responsibly paying dividends, if it's sustainably paying dividends. So if a company's earnings if the company's paying out dividends of 101% of earnings, then at some point, the company's going to have to make a change because they won't have the money to pay the dividends. By the same token, if the company's paying out virtually none of its earnings, then we would expect there to be a change because the company will just be hoarding tremendous amounts of cash, theoretically. So we just want to get a sense for where this is and how sustainable it is. So one of the things we look at is the payout ratio. That's the percentage that dividends make up of earnings. The S&P 500 averages about a 40% payout ratio. This company's payout ratio is 41.5%, so right in line with the average, and that's for last year. For the last 5 years, it's 41%, but that's a misnomer because they didn't pay any dividends in 2014 and 15. So it was high, it was a little bit high, it was 70% in 2016, and it was over 50% in 2017. I didn't like those numbers very much, but the earnings have continued to go up, and the dividends have sort of remained rough, have reduced proportionately to earnings, and the result is we now have dividends relative to earnings that are very, very sustainable, and that makes this company even more attractive. Another thing that we like to look at is dividend safety in the context of cash flow. Oftentimes companies will have decent earnings, but they have significant capital expenditures which reduce their ability to pay dividends. So we look at this and we say, we'll look at 2018. The company made about $60 million in cash from operating activities. They had capital expenditures of $4.94 million. That left them with free cash flow of $55.88 million. They paid dividends of $23 million, which meant that they used about 41.4% of their free cash flow to pay dividends. That's in line with what the S&P 500 does. It's conservative, it's intelligent. It's been in that same range for the 3 years they paid dividends. So again, these are indications that this company is not overpaying dividends and these dividends are sustainable. And in theory, as the earnings go up, the dividend should increase as well. So dividend safety in the context of current debt load. Oftentimes a company has a tremendous amount of debt. And when they have debt, if interest rates were to go up and they were to roll over the debt into the newer, higher interest rates, they would be less and less able to pay dividends as they're using more and more of their cash flow to pay down interest. In this case, it really is irrelevant. The company has no debt, and as a result, debt will have the interest rates in the market will have no impact on this company's ability to pay debt, to pay dividends. So long story short, dividend safety in the context of its current debt load, the company is completely safe because it has no debt.